Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Every investor wants to know where to put their money so that they can make a good return and grow their wealth. Product selection is an important part of this process, and we tend to focus a lot of our energies in product selection. So we're always trying to find the best investment, what is the best thing to do at this point, and to time the market. But there are some mistakes that we tend to make in product selection which can actually affect our wealth creation journey. Instead of always trying to ask which is the best product to invest in, let's try to invert that question and try to understand what are the mistakes that investors make when they select products. The first and the most obvious mistake that many investors are guilty of is chasing performance. So, when we see an investment that has a really great track record, we're very tempted to participate in that investment because it looks like there's proof that it's a good investment. After all, 1, 3, and 5 year returns are great, showing us that this is a stable and predictable kind of investment. But markets are hardly ever stable or predictable, and they can be full of surprises, which is why past performance is not a great measure of how to select a good product. The second important thing that investors miss out is that although they do study returns, they fail to analyze what is the source of these returns. The source of returns matters a lot when you're choosing a product, simply because you need to understand why this performance has come in and whether it is sustainable or not. So, for example, if you're looking at an equity investment, you might want to understand whether this performance has come because of cheap valuations in the past, because there's a lot of momentum in that particular idea, or whether there's been an actual growth and re-rating within that company. When we understand these things, we'll be better prepared for risks and rewards that are available in the future. This doesn't apply only to equity, it applies to fixed income as well. So if you're looking at a fixed income strategy, in certain cycles, you might see that performance is because of taking duration calls, which works when you're moving from an upward or a higher interest rate level to a lower interest rate level. The same call is unlikely to work when interest rates are moving in the opposite direction. Similarly, sometimes you make great returns because of credit spreads, because at one point in the cycle, spreads were quite wide, and because you've had better performance, better lending standards, and you see those spreads compress. So then you get extra returns in that segment as well. So when you're looking at the sources of performance, you have a better understanding of whether this kind of performance is repeatable or not. The third area where we tend to make mistakes in product selection is that we tend to ignore sub-asset classes. So for example, when we look at investors today who are very keen on participating in equity, they tend to be allocated more towards small and mid caps. This is partly because of their stellar past performance track record, but also the hype around being a long-term investor and wanting to create wealth. When you look at only one part of the equity market, you're ignoring the other sub-asset classes. So sub-asset classes could be things like looking at maybe blue chips within the same asset class of equity, or looking at global, where you might have the underlying instrument is still equity, but you have a different geographic exposure. When we start understanding the power of sub-asset classes, product selection can actually be more holistic and help us manage risk better. What are some other great ways to pick products? Why don't you tell us in the comments?
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In this video, I'm going to talk about mistakes that happen in bull markets. Charlie Munger once famously said that the world is not driven by greed, it's driven by envy, which basically means we're more focused on how other people are doing rather than what we want to achieve for ourselves. So the driver of our behavior is actually our jealousy and not what we aspire to, or even if you want to label it as greed, that's not what's driving us to make these behavioral mistakes. So let's look at the three big behavioral traps that are there in a bull market. The first one is overconfidence, because when we've seen sustained performance for a while, and even when that performance comes in securities or instruments where we've not put in a lot of effort in terms of research and risk management, then we tend to believe that our skill is actually much better than it really is. This will come to us as a rude shock when the cycle turns and it turns out that we haven't actually done all of the groundwork to make good, sound financial decisions. Overconfidence is quite common in bull markets, and it's difficult to know that you're overconfident until you see that tide turn. The second common behavioral issue that you notice in bull markets is herding. Herding is when you see a group of people or many hordes of people going towards the same idea with high conviction. This tends to happen because it's a reinforcing cycle where you see performance, then you have a new set of investors who believe in that particular security or asset class, which again, because of the momentum, delivers higher performance. And herding also has this pattern where people tend to ignore bad news or underplay it and understate it and only focus on the good news. So when you see herding, you'll see a lot of consensus views, you will see very limited discussion on risks or downside potential. Herding is quite dangerous, especially if you're part of the herd. You really don't know how much momentum is left behind you, and you don't want to be the last one standing when things fall apart. So it's important to see what other people are doing around you and understand whether you're part of something that has a sound framework or whether you're part of something that's built on everyone's emotions about how an investment is going to perform. The third behavioral issue that we notice in bull markets is that people get envious. So when you're comparing your returns with the next person's, you might feel a little bit annoyed that they're doing better than you, but someone is always going to get richer faster than you, and that, according to Charlie Munger, is not a tragedy. So it's time to practice some safe and sensible investing. If you have other behavioral trends that you've noticed in this bull market, let us know in the comments below.